So something really strange happened last October when mortgage rates hit 8%. I remember this vividly because I was scrolling Twitter and a post that caught my attention. I thought it was the craziest thing I'd ever seen. QRA synthesis, buy all assets, Janet saved Christmas. Let's go. Janet Yellen has been manipulating markets, including housing and mortgage rates. You'll never believe how she did it and what it means for the future.
Our next guest says that the Treasury refunding plan has opened the floodgates to buy all assets. Let's bring in Damp Spring Advisor CEO Andy Constance.
Yeah, so Melissa, the first thing I did today was look at the quarterly refunding announcement at 8:30 and found that the bonds issuance for today, for this quarter, was being kept the same. But importantly, next quarter, they're only increasing the bond supply by $10 billion.
Now, a lot of that may be mumbo jumbo lingo to you, but I'm going to make it super simple, and then we'll get into how this could impact mortgage rates going forward. You see, the US government needs to borrow money. It's got a $2 trillion deficit every year, and they can borrow long term, like you and I when we get a mortgage, or they can borrow short term, like a credit card. Only if you're the US government, you get a much lower rate. Typically, the government spreads this proportionally to make sure that taxpayers pay the lowest amount of interest possible.
Treasury likes to manage debt in a way that's going to have the lowest interest expense to the taxpayer over a long period of time. In order to do so, it's got some rules that it follows in terms of how it issues Treasury securities, right?
But they did something different last year. Instead of getting some 30-year and 20-year loans, they just put it all on the credit card. Super short loans, 30, 60, 90 days. Now, this had a massive impact on 10-year borrowing costs because there was a lot less to issue. There was more demand for it and lower rates. Constance said this: they massively increased the supply and yields rose 1% or 100 basis points. Stocks fell 10%. They eased the increases and stocks rallied 10%.
And when the supply is reduced, given demand, the price is going to be higher and the yield is going to be lower.
Guys, this is the most basic market manipulation there is. The Treasury Secretary literally has the lever on where interest rates will go just by deciding how they borrow money.
To the extent that, you might question this might have an effect, just imagine that tomorrow Treasury announces it's going to issue $1 trillion of intermediate and long-term debt. What do you think that would do to the markets and the economy?
A lot of this has gone over my head for a very long time, but it's so crucial that we understand this because this is absolutely impacting our housing market. And when you understand what they're doing, it's like Newton's law, there's going to be an equal and opposite reaction. Okay, so Nouriel Roubini, he's a Harvard-educated economist. He used to work in the Treasury Department during the Clinton years. He joined forces with Stephen Moran, who also worked for the Treasury Department under the Trump administration. Now, to study just what the Treasury Department was up to and how it is impacting markets. And just so you know, they called this activism.
They've adopted forward guidance as well. For the last two refunding announcements, Treasury has asserted that it does not anticipate any further increases in coupon auction sizes for at least the next several auctions, which of course conveniently goes just to the other side of the election.
They are calling it political, and they say it needs to stop because it is active market manipulation.
And we believe that the fact that growth has remained above potential and inflation has remained sticky is due to the fact that Treasury has effectively interfered with what the Fed has done and has tried to undo the impact of the Fed tightening because they want to maintain financial conditions to stimulate growth during this part of the business cycle.
And just a quick recap for those of you that don't know, the Treasury Department is in charge of all the borrowing for the US government. They keep track of all of the debt, and when they need to raise money, they issue debt. That's usually what people say when they're saying supply. It's the supply of debt that they're issuing, which is just a fancy way of saying they take out a loan. Now, Janet Yellen, appointed by Joe Biden, is running the Treasury Department. She used to be the Federal Reserve chair. Now that's Jerome Powell. But because the government borrows and is quote unquote the safest form of debt, then basically all interest rates have to be higher than what the US government borrows at. Thus, mortgage rates typically remain about 1.5% to 2.5% higher than what it costs the US to borrow for 10 years. Right now, it costs the US 4.25%, and mortgage rates are around 6.75%. That's a higher spread than average, and a lot of people have been predicting that that spread will compress over time, leading to lower rates regardless of whether the 10-year government bond the yield actually drops. But see, there's a problem.
Effectively, this ATR reduced the 10-year Treasury by 25 basis points, but undoing it implies that you don't go back to the previous 25 basis points level, but for a while you're going to be above that. So you're going from minus 25 to plus 25. So it's a 50 basis points increase.
So to translate, if they were to undo this policy, we would be looking at a 10-year Treasury 0.5% higher, and thus mortgage rates would be 0.5% higher than they currently are. Even if we do see that spread between the 10-year government bond rate and the mortgage rates compress, we still have the headwind of undoing this political activism in our mortgage market. We still may end up with a 10-year that's 0.5 point higher. This is a headwind to lower mortgage rates, but it doesn't stop there. You see, there's a real problem in this, and it goes back to why Janet Yellen was actually doing this in the first place. You see, I'm generally a more conservative person, and I've been very cynical of Janet Yellen. She's got a track record that I could criticize over and over again for being political. So it does raise the question, is she doing this to make Democrats look better? After all, the stock market rally looks good for incumbents. But I'm concerned that that's not the reason. I'm concerned that the truth may be worse. You see, Andy Constant brings up this point that the Treasury may have done this out of fear. You see, we go back to October when mortgage rates hit 8%. They hit 8% because the Treasury had one of the worst bond auctions of our lifetime. They couldn't sell long-dated Treasuries. They couldn't borrow because there was nobody to loan the government money. That the yield wasn't high enough, and this could be the real problem. There's actually no new buyers without the Fed stepping in. So it could be that Yellen reduced long-dated debt issuance because she had to. And while the market celebrated this, it's a temporary solution that could become permanent and will continue to cost taxpayers more and more in interest expense. We could be witnessing what some call a debt spiral, and it could have started almost a year ago.
And the Fed is, pretty focused on making sure that none of the auctions fail. But a non-failure of the auction doesn't mean that necessarily that the market's subdued. You could see a lot longer tails, higher yields on auctions relative to existing securities, and so things could get out of hand very, very quickly.
Now, regardless of your political persuasion, this is a problem that's much bigger. And I think many people will be surprised that in the next recession, it's very possible that interest rates won't even drop all that much. In fact, they could go up. You see, there's really no telling how the government will intervene, but it's almost impossible to imagine a lack of intervention. There's simply too much debt and too much spending. And while there's no doubt this will impact the borrowing costs for housing, it will also impact the very currency we use to buy the house. So this isn't a video to convince you to buy or not buy. I'll let you decide that based on your situation. But what I do want to do is share what Charlie Munger had to say, as I think it's timeless advice and it will leave us all a little bit better after watching this.
What the secret to life is, to a long and happy life. And I just wonder if you were...
Now that is easy because it's so simple.
What is it?
You don't have a lot of envy, you don't have a lot of resentment, you don't overspend your income, you stay charitable in spite of your troubles, you deal with reliable people, and you do what you're supposed to do. And all these simple rules work so well to make your life better, and they're so trite.
How old were you when you figured this out?
About 7.
Thanks for watching. I'll see you next Saturday.